Well, kia ora, tātou katoa, tēnā koutou katoa. Welcome everyone to Te Pūtea Mātua, the Reserve Bank of New Zealand. Thank you for being here at short order. Today we have reduced the official cash rate to 0.25%, that is down from the 1% level. We've also committed to keeping the OCR at 0.25% for at least 1 year. We've made this commitment around the time period for two reasons primarily. The first one is to give people who are pricing interest rates in the market certainty around our behaviours over the period, and also to highlight to the banks and general public that we are not at this point contemplating negative interest rates or a negative OCR. If further stimulus was necessary at some point, which is not the case at the moment, we would consider using our additional tools, for example, large-scale asset purchases of New Zealand government bonds. No matter what tools we use, our mandate remains the same, and that is to achieve and maintain low and stable inflation and to contribute to maximum sustainable employment. Why have we made these announcements now and today? Well, suffice to say that over recent days, and certainly since our February monetary policy statement, the negative economic implications of the COVID-19 virus is becoming clearer and more significant. Global trade, travel, and business and consumer spending have been curtailed significantly. Increasingly, governments, including our own, internationally, have imposed a variety of restraints on people movement within and across international borders, primarily in an effort to mitigate the transmission of the virus. The negative impact on the New Zealand economy is, and will continue to be, significant. Demand for New Zealand's goods and services will be constrained, as will domestic production. And spending and investment will be subdued for an extended period, in particular while the responses to the COVID-19 virus evolve. Several factors continue to assist and support economic activity in New Zealand. First, we are in a strong economic position at present. Inflation is low and stable, and employment has been around its maximum sustainable level. Second, New Zealand's financial system remains sound and our major financial institutions are well capitalised and liquid. Our bank's capital holdings are currently above their regulatory minimum. This has enabled us today to delay the commencement of our bank capital increases by at least 1 year. Just this delay alone means the banks have additional headroom of around $47 billion extra that can be extended as credit to their customers. And as a scaler, that is around 1.5 years of regular usual credit growth. We've also working to make sure that the banking system continues to function normally. We've reminded banks that they also have capital buffers, that's in addition to this headroom, that can be used in unusual times, and that these are evolving unusual times. We've also reminded all financial market participants of our suite of tools that are available to ensure there is sufficient liquidity in the system for the orderly operation of our money, debt and foreign exchange markets. These markets remain orderly, and I do want to commend the participants in these markets for retaining their cool heads. Third, the government is operating an expansionary fiscal policy with plenty of headroom and has imminent intentions to increase its support with a fiscal package to provide both targeted and broad-based economic support. So this is very much a case of monetary and fiscal policy working together. Fourth, the New Zealand dollar exchange rate has depreciated against our trading partners, and this continues to act as a partial buffer for export earnings. And of course, as already noted, the Monetary Policy Committee agreed at our meeting yesterday to provide further support with the OCR now at a record low of 0.25%. And we agreed to hold that position for at least 12 months, and we also agreed our preferred options beyond that, if we needed to take additional action, would be large-scale asset purchases of government bonds. I want to finish really by urging all New Zealanders to communicate with the financial institutions that serve you and discuss any concerns that you may have. This is the time to over-communicate. At the same time, I'd also urge all New Zealanders to listen carefully to the official health experts as to the appropriate social behaviour. Ngā mihi, thank you very much. We're open for questions and I'm supported by the usual suspects.
What sort of size?
Could you introduce yourself, sorry, just for the cameras behind?
Jason Walls from the New Zealand Herald. What sort of size infrastructure or spending package from the government that they're announcing on Tuesday would you be expecting or want them to see?
We can leave that for the government tomorrow. I want to re-emphasise that we have made, the Monetary Policy Committee made these decisions in full line of sight of the fiscal package and also in full line of sight of what the rest of the Reserve Bank was doing around financial market stability.
Dalipa Fonseca from Newsroom. Why don't you want interest rates to go below zero?
At this point, we think the most effective tool for the type of situation in front of us would be the large-scale asset purchases. Recently, we talked about the suite of tools we have available and the readiness for them. The scenario that we provided in our recent speech, where we talked about a scenario of a slow aggregate demand issue in a traditional monetary policy sense, and we talked about lower interest rates, if not possibly negative. That's not the scenario we're in. We're in a much sharper situation where we would be looking to be more direct in our impact.
Is it also because below zero interest rates would affect bank profits?
No, I think in a simple sense, not all banks are ready to even actually manage negative interest rates. So again, when we talked about it, we ourselves here at the Reserve Bank of New Zealand are ready, but not all retail banks are ready. And we want them to be focusing on more important issues at this time rather than that readiness, more important issues around looking after their customers.
Tom Stracker from Stuff. What is the nature of the commitment to keep rates at 4.25%? I see it's not binding.
The commitment stands here. It's the Reserve Bank's word. People said, well, can you commit that? We say yes, because it's our commitment. It's not dependent on anything else. And if we had to do additional stimulus, well, then we would use additional tools.
Hamish Rutherford from the New Zealand Herald. You said shelving bank capital plans will increase credit massively in the economy. Is that different to the message that you told us when you were bringing the proposals forward a few months ago?
No, it's absolutely consistent with everything we've been saying, that you want banks to be well capitalised, you want them to improve on their capital positions in good times so that in times like this they have sufficient capital to do the right thing. And so that is exactly the case. The capital levels, just so people are clear, the current bank capital levels are quite close to where we want them to be as a regulatory minimum. So current levels are above current regulatory minimum, but are near where we wanted them to be in the future. So they do have a lot of bandwidth, they do have the capital buffer, and we're saying use it if needed.
How much will you allow them to cushion the economy?
The buffers are well understood by the banks. Do you want to just into the microphone, please?
The banks have capital levels, broadly speaking, 3 to 4 percentage points above their regulatory minimum. Those regulatory minimum also have a buffer inside, what's called a conservation buffer, where we would impose dividend restrictions and so forth. So that's another layer underneath that. But yeah, there's substantial room there that they've got above requirements to be able to continue to lend. In addition to the deferral of the capital proposals, there's probably another couple of years at least of credit growth that could be sustained before they hit minimum.
Sorry for sharing the microphone.
Richard Harman, Politic. Did the committee yesterday have access to revised GDP figures and projections, and if so, what were they?
We had access to the government's fiscal package at the broadest levels that were necessary for our monetary policy. we didn't have access to official GDP forecasts.
Janae Tibshirani from interest.co.nz. Why did you not signal more strongly last week at the release of your unconditional monetary policy document that perhaps some more monetary action was coming? There seemed to be quite a positive, relatively speaking, outlook at that point.
You please recall that last week was not about a positive economic outlook. It was talking about the monetary policy tools that we have. That was the purpose of this speech. The monetary policy statement in February also emphasised that this issue was just evolving during that period and that we were standing ready to do whatever it takes. Our good fortune, our good position, was our starting economic position for the central bank, which gave us time to observe what was happening internationally, other governments' responses, and also our own government's response, as well as observe how this COVID-19 virus was emerging. We are now in a much better informed position to make these decisions.
I'll just add that
The weekend made a difference, didn't it?
I was just going to add that this has been rapidly evolving. The spread through Europe and the US the latter part of last week, the government's decisions to impose extended travel restrictions over the weekend. All of that has meant that the economic impact is deteriorated in the outlook significantly over the last week, and so that's what brought us forward to make decisions now.
Giles Beckford, Rain New Zealand. Just a variation on Janae's question, which is, should you have done this 2 weeks ago? Notwithstanding the changing circumstances, should have you been more ahead of the curve?
I can't. That's a hypothetical question. I can't judge what the committee would have said if we sat there 2 weeks ago, given the information that's happened 2 weeks ago to now.
Matthew Brockman from Bloomberg. To what extent is there global coordination going on, given that we saw the Fed act shortly after you? Were you in touch with other central banks over the weekend?
We've operated independently, but we're all singing off the same song sheet.
Can I then ask a question about your own economic outlook? What do you expect to happen to growth and inflation at this juncture?
We're expecting growth and inflation to be lower.
You can't tell us any more than that.
No.
Thomas Collins.
Sorry, down the back.
Yep, Benedict Collins from One News. Have you done any modelling looking at how many job losses there could be?
Not specifically ourselves, Young, or Christian, sorry.
At the moment, the committee just looked at a broad range of different scenarios and different assumptions to give us a rough ballpark of how much monetary stimulus we should be providing. We're due to put out our full set projections in May, and there's quite a lot of work that goes around that. The decision on the weekend was really just getting a sense of the scale and direction of what policy action we needed to take right now.
I think it'd be just fair to say that we do expect this to be a severe impact on the economy and on people, and that's the unfortunate circumstance that we're in, which is, we don't have specific numbers, as Christian and Adrian are saying, but we are saying that this is going to spill through some business failures and some unemployment. That is what we're trying to lean against and provide support to the economy for, and the government's fiscal package is very much aimed at that. So, yeah, we can't quantify it specifically, but we acknowledge that this will have harm a number of people in the New Zealand economy.
Ben Edwards, NBR, can you give us a sense of maybe what the next tipping point would be as to when you would look to purchase government bonds?
No, I can't. I think you'll recognise those moments when they are upon you. So, at this point, we are comfortable to see how the fiscal package unfolds, and more importantly, to see how the COVID-19 virus and the regulatory impacts unfold as well. We do have to recall at the moment New Zealand is only got a few very isolated cases. That's not the situation in the rest of the world. I would say that if that became widespread within New Zealand, that's a whole different ballgame again.
So are you not giving out any details of how the large-scale asset purchases will work, and when might we have details?
You've got details. That was told you last week around that one of our tools would be large-scale asset purchases of government bonds. So we talk about it in that speech. The documents, we've got more work coming out in coming weeks around it. It's not that complicated really. We'd be buying government bonds in the secondary market. We'd probably be wanting to do it reasonably across the yield curve so as not to influence any one particular point in the yield curve, and we'd be doing it to provide a significant liquidity impost boost into the economy for monetary policy purposes. Christian's about to correct me.
It's bang on. It wouldn't be dissimilar to large-scale asset purchases that you've seen overseas in the way that they've been designed and implemented, but with obviously an eye to the nature of our own financial markets.
How big could you go? What's the line?
As big as is needed. One of the interesting challenges in New Zealand, it's the irony of being well behaved, is that we don't have massive amounts of government debt to buy, but we certainly have quite a lot to buy for a significant monetary impulse. They aren't the only assets that we could buy, and large-scale asset purchasing is also not the only tool that we have. We also have the FX, we also have the swaps market, and on and on and on. I'm kind of repeating last week's speech now.
What would be your advice to consumers who maybe see a cut in their mortgage payments come through now, a bit more money that they're expecting, but are wondering, you know, what they should spend on, I suppose, things the way they are? What would be your advice to them?
To think wisely about how they want to use that cash in these times.
Billy from Business Desk. Presumably, in the scenarios that you looked at yesterday, you'd have had a sort of a short end, how long this might last, and a long end. What are those two extremes?
We're operating on the fact that this is going to be something of, I would say, medium duration, around following, I suppose, the central path that the Ministry of Health is providing. That we're talking a 12-month period of that type of duration.
When was the decision made to call the meeting yesterday?
I'm trying to think. Bob, I can't remember. When did I call you?
Saturday afternoon.
Saturday.
Before.
We've been, by the way, we've been in regular contact on a continuous basis. We've also been operating within the bank on a heightened level of alert with various committees working so that the whole of bank itself knows exactly what each arm is doing, because we have a very wide remit from financial market stability, financial institution soundness, through to setting the interest rate. And so our committee had been informed all the way through. We agreed on Saturday, let's get together. We think a decision is useful.
So was the government's decision to impose this self-isolation for 40 days, was that the kind of final thing that confirmed to have this meeting? Or?
It helped.
Thomas Coughlin's stuff, there's been some concern overseas that plummeting oil prices and the wider crisis are hammering junk bond market and lower grade investment grade investment grade bonds, potentially leading to a liquidity crisis in those areas. Are you concerned about that happening over here, and if so, what would your response be?
We're watching all financial market pricing very carefully, and we are writ loud. I think it's very obvious to the New Zealand financial market participants that we are there standing ready with all liquidity provision, and the markets have been very comforted by it. Christian?
Yeah, I'd say that we don't have a large junk bond or sub-investment grade bond market in New Zealand, but we're watching that globally as a signal about risk aversion and access to funding. We're very focused on the bank's funding positions and how our term funding markets are open. At the moment, the feedback we're getting from the banks is that they're very well funded. They're not asking for more liquidity, but we're making very clear to them that it's available if needed. Probably, Jeff, if you want to.
That's good.
I appreciate the fact that you haven't seen the GDP figures yet, but at this stage, are you anticipating a recession in New Zealand?
I think it's kind of academic to worry about whether it's technically called a recession or not. It's going to be a period of very weak economic activity. A recession is what's that technically called, a recession?
It's 2 negative quarters of GDP growth.
Okay, well.
Are you anticipating that?
I'm anticipating very weak economic growth.
But are you
If it's a recession, it's a recession. I don't know.
But are you anticipating 2 negative quarters in a row GDP growth?
As we said, we haven't got specific quantitative forecasts at this point. We're going to update them. What the Governor has said is we've done looked at some scenarios, and as I said before, we see significant economic shock and negative impact, if you like, to employment and to activity. I think you're asking us for more precision than what we've got. This is going to be
some
adverse.
scenarios have more than 2 negative quarters of growth.
So in some scenarios, you see New Zealand going into a recession?
Yes, which is what I said at the beginning of the speech. It is significant.
What does the decision today, putting the OCR at 0.25 for 12 months, what does it mean for events like this? Are you still having a review at March 25?
Not March 25, that was in the bottom of your media pack there, because today we think is close enough to March 25 to probably give us a rest on setting that. Our next one is May 13, our next scheduled monetary policy statement, so we're back to a regular schedule, unless otherwise needed.
Just wondering, what other regulatory initiatives are you looking at deferring for banks?
We're going through, including with our Council of Financial Regulator partners, CPMA, MB, Treasury and the Commerce Commission, looking at all the regulatory initiatives that are underway and which of those, if any, may make sense to slow down or defer for a period of time. Banks, obviously, insurance sector, are all busy themselves dealing with the impacts of this event, and so we want to make sure there's appropriate bandwidth for them and for ourselves in focusing endeavour. So we've got a number of things that we're looking at, from reporting mechanisms, or we've been consulting on some of the details of reporting over breaches, right through to a bigger range of things. So we'll update in the next few days what that is and issue a statement of what we can and can't do.
And we're aiming for a comprehensive Council of Financial Regulator update, because we are only one of many regulatory authorities that are involved in the financial system.
Does that include just pushing pause on the deposit protection scheme, like work on that?
The legislative review material is still going according to the timetable that we can see, and I think it went out for consultation last week. So we'll watch the space. Just to give you a sense of how difficult this is, consulting in a time of social distancing, how do we do that? So, we need to really engage properly, which is also why I come back to these scenarios. I think the sooner that the media just get used to the idea that these are scenarios and not specific point forecasts, the better the reporting and questions will be.
What would you say to criticism, or what do you say to criticism that this is too little too late in terms of the reduction?
Nothing. Oh, I'm sorry, are you saying we're doing too little too late?
Yeah, I guess criticism that this is too little too late, that this interest rate cut should be...
An interest rate cut was not going to stop COVID-19 virus. And monetary policy should be done in a medium-term framework and with the best information possible, and in line of sight of what is happening to other economic activity, for example, fiscal policy. I would love to think that New Zealand is in exactly the right position in a horrible situation. We're in the best possible position we can. So, wonderful. Thank you very much. I do, please think hard about our own social responsibility with regard to I suppose reporting in very, very difficult economic times, the bank is on heightened alert. Real news beats fake news. Thank you.
Awesome, that paint the stream was really great. So it's